ASC 606, Revenue Recognition, the complete masterclass. Hello and welcome to CandiMentor. Today we decode ASC 606, the revenue standard that forms the foundation of how companies recognize revenue from customers. This session is designed as a full preparation guide. Whether you're learning for professional growth, practical application, or future roles, this masterclass will give you clarity and confidence. Before we begin, make sure you subscribe to get updates. End of masterclass. Sign up one time. What ASC 606 is? ASC 606 is the U.S. accounting standard for revenue from contracts with customers. It is principles-based and applies across all industries. Instead of rigid rules, it requires thoughtful judgment. This standard replaced a large collection of older, industry-specific guidance and brought consistency to how companies record revenue. Understanding this standard is essential for practical accounting, financial reporting, and real-world scenarios. The core 5-step model. Think of ASC 606 as a structured 5-step roadmap. Step 1. Identify the contract. Step 2. Identify the promises, also called performance obligations. Step 3. Determine the transaction price. Step 4. Allocate that price to each obligation. Step 5. Recognize revenue when those obligations are satisfied. Keep this flow in your mind. It lets you approach any revenue scenario with clarity and structure. Step 1. Identify the contract. A contract exists when both parties approve and commit to the terms. The arrangement must have commercial substance, and the company must expect to collect the consideration. Sometimes multiple documents are combined into a single contract when they are negotiated together or economically linked. Contract modifications, such as scope changes or price updates, often determine whether we account for a change prospectively or with a catch-up. Step 2. Identify performance obligations. A performance obligation is a promise to transfer a good or service to the customer. Something is distinct if it is capable of being distinct, and distinct within the context of the contract. If goods or services are highly interrelated, they combine into a single obligation. For repeated services, such as monthly hosting or regular maintenance, the series guidance may apply. Step 3. Determine the transaction price. The transaction price is the amount the entity expects to receive. It includes fixed consideration, variable amounts, non-cash consideration, and any amounts payable to the customer. Variable amounts, such as discounts, rebates, bonuses, or penalties, are estimated using either the expected value method or the most likely amount. Apply the constraint so revenue is recognized only when the likelihood of reversal is low. Assess whether a significant financing component exists based on the timing of payments. Step 4. Allocate the transaction price. Allocate the transaction price to each performance obligation based on standalone selling prices. If the standalone price is not observable, estimate it using adjusted market assessment, expected cost plus margin, or the residual approach. Explain your reasoning clearly. Proper allocation ensures the revenue pattern reflects the economics of the contract. You may illustrate this with a simple example, such as allocating price between hardware and support services. That is special. Step 5. Revenue recognition. Transfer of control revenue is recognized when control transfers to the customer. Control can transfer over time or at a point in time. It transfers over time if the customer receives benefits as the entity performs, if the customer controls the asset being created, or if the asset cannot be redirected elsewhere and the entity has a right to payment. Measure progress using output methods like milestones or input methods like cost to cost. End. Variable consideration. Deep dive. Variable consideration is estimated at the start and updated as circumstances change. Use expected value when there are many possible outcomes. Use most likely amount when there are only two major outcomes. Apply the constraint so revenue is not overstated. Special situations, such as sales-based royalties for intellectual property, follow unique timing rules. Contract assets and contract liabilities. A contract asset arises when the entity performs more than it bills. A contract liability arises when the entity bills more than it performs. Explain how the balance changes. Opening amounts, new performance, billings, cash collections, and closing amounts. When the right to bill becomes unconditional, contract assets convert to receivables. Principal versus agent. Determine whether the entity controls the promised good or service before transfer. If it controls the good or service, revenue is recognized gross as a principal. If it only arranges for another party to provide the good or service, revenue is recognized net as an agent. Consider indicators such as inventory risk, price control, and who fulfills the promise. End. Contract costs. Incremental costs of obtaining a contract, such as sales commissions, are capitalized when recoverable. Costs to fulfill a contract are capitalized when they create or enhance resources used to satisfy obligations. Amortize these costs over the benefit period and test for impairment when necessary. Practical expedients allow immediate expensing if the benefit period is 1 year or less. Contract modifications. Contract modifications change the scope, price, or both. If the added goods or services are distinct and priced at their standalone values, treat the modification as a separate contract. Otherwise, adjust the existing contract. Use cumulative catch-up when the change affects performance already completed, and use prospective adjustments for future-focused changes. End. Licenses and intellectual property licenses fall into two categories. Right-to-use licenses transfer a static right and are recognized at a point in time. Right-to-access licenses provide ongoing benefits and are recognized over time. Consider hosting, updates, and the nature of the customer's access when making the classification. End. Warranties. Assurance-type warranties guarantee the product meets specifications and are accounted for as liabilities or expenses. Service-type warranties provide additional services and become separate performance obligations. Extended warranties often fall into this category and are recognized over the warranty period. Bill and hold bill occurs when the customer is billed before receiving the goods. Revenue is recognized only if control has transferred. Key criteria include a substantive customer reason, identification of goods, readiness for transfer, and the seller's inability to use the goods for other purposes. Upfront fees. Upfront or activation fees must be evaluated to determine if they relate to a distinct service. If they do not provide a separate good or service, allocate them to future performance and recognize them over the service period. A simple activation example helps explain the concept. Breakage. Breakage refers to customer rights expected to go unused. For example, unredeemed gift cards. Estimate expected breakage using historical patterns and recognize it proportionately as obligations are satisfied. Clear documentation of assumptions is essential. End. Disclosures. ASC 606 requires detailed disclosures that tell the story behind revenue. These include disaggregated revenue, contract balances, remaining performance obligations, and significant judgments. Good disclosures connect financial numbers with underlying business activity. End quote. Common scenarios across industries. Several patterns appear across industries. SaaS arrangements often combine subscriptions and implementation services. Hardware and software bundles require careful license classification. Rebates, returns, and loyalty schemes introduce variable consideration and breakage. Each scenario benefits from walking through the 5-step model. Red flags and pitfalls. Be cautious about overly optimistic variable consideration estimates. Misidentifying performance obligations can distort revenue timing. Principal versus agent misclassification can significantly change reported figures. Clear documentation and conservative estimation are essential to avoid issues. Industry-specific applications: SaaS, telecom, construction, e-commerce, gaming, pharma. Each industry brings unique challenges. SaaS involves implementation, renewals, and upgrades. Telecom deals with handset and service allocations. Construction often recognizes revenue over time using cost to cost. E-commerce handles returns, coupons, and loyalty points. Gaming distinguishes durable from consumable virtual items. Pharma deals with milestone payments and intellectual property licensing. Short numeric examples help bring these applications to life. Numerical examples: allocation, variable consideration, financing. Use simple numbers to illustrate allocation. If hardware SSP is 700 and support SSP is 300, a bundle of 1,000 splits proportionately. Variable consideration using expected value involves multiplying outcomes by probability. Significant financing components require present value calculations and interest recognition. Journal entry demonstrations. Full debit and credit. Show the mechanics step by step. Prepayment received. Debit cash, credit contract liability. Unbilled work. Debit contract asset, credit revenue. Conversion to receivable. Debit accounts receivable. Credit contract asset. Capitalizing commissions. Debit contract cost asset, credit cash. Amortization. Debit expense, credit accumulated amortization. Variable consideration adjustments follow a similar pattern. Practical expedients. Financing, right to invoice, costs, portfolio. ASC 606 offers helpful simplifications. You can ignore financing effects if the payment period is less than a year. Right to invoice can simplify recognition when billing matches performance. Short-term contract costs can be expensed. Portfolio treatment allows grouping similar contracts to reduce complexity. End. Consignment arrangements. In consignment, the supplier retains control until the consignee sells the goods. Revenue is not recognized at shipment, but only when the final customer buys the product. Indicators include inventory risk and the ability to recall goods. Contract asset and liability roll-forward logic track. Contract assets and liabilities using a T-account approach. Opening amounts, performance added, revenue recognized, billings, collections, and closing amounts. Include impacts from modifications, impairments, and foreign exchange. License classification deep dive. Right to use versus right to access. Right to use licenses transfer control at a point in time to the customer. Right to access licenses involve ongoing updates or activities, so revenue is recognized over time. Examples include downloadable software versus cloud-based access. Material rights contracts offering discounts or options priced below market may create material rights. These rights are separate performance obligations. Estimate the standalone selling price of the option and allocate revenue accordingly. Recognition occurs when the option is exercised or expires. Non-refundable upfront fees. Full example. For an activation fee tied to a 12-month service, determine whether the setup is a distinct promise. If not distinct, allocate the fee to the service period. Narrate the allocation and revenue recognition month by month, along with the journal entries. Returns, refund liabilities, and right of return assets. Estimate expected returns at the time of sale. Record revenue net of expected returns. A refund liability for the amount expected to be refunded, and a right of return asset for goods expected to be recovered. Explain the presentation clearly. Significant financing components. Interest separation. When payment timing creates financing, separate revenue from interest. Recognize revenue at present value using an appropriate discount rate. Recognize interest income over time as financing unwinds. This provides a clearer picture of operating performance. Contract combination and segmentation tests. Combine contracts negotiated together or those that are economically linked. Segment contracts with multiple distinct promises into separate performance obligations. Common examples include equipment plus installation plus multi-year maintenance. Explain how each element is identified. Additional numerical walkthroughs and T-account narration. Walk through another residual allocation example. Then demonstrate a contract asset roll forward, opening, performance added, invoiced amounts, and closing balance. These walkthroughs reinforce both conceptual and mechanical understanding. Practical study tips. When learning ASC 606, always start with the 5-step model. State assumptions clearly. Use small numbers to test your understanding. Provide sensitivity analysis when situations involve variable estimates. These habits build strong technical judgment. Final wrap and learning advice. Always return to the 5-step model in any revenue situation. Identify performance obligations carefully. Estimate transaction prices thoughtfully. Track contract balances with clarity. If you learned something today, subscribe to CandiMentor. We are building the world's best learning hub for accounting, finance, and technical knowledge, and you should be part of it.